Starting to invest might seem overwhelming, but it's actually much simpler than you think. Whether you're a complete beginner or just looking to refine your strategy, you're in the right place to learn how to make your money work for you. In this video, we'll break down the basics and show you how easy it can be to get started on your investment journey. Let's dive in. Step number 1, assess your financial situation. Before you start investing, it's important to get a clear picture of where you stand financially. Here's what you need to do. Track your income and expenses. How much money do you make each month, and where is it going? Pay down high-interest debt. If you have credit card debt or other high-interest loans, it's usually a good idea to pay those off first. The interest on these debts can quickly outweigh any returns you'd get from investing. Create an emergency fund. Ideally, you should have 3 to 6 months worth of living expenses saved up for unexpected situations, like a job loss or medical emergency. The goal here is to make sure you're in a solid position before you start investing. This doesn't mean you have to be debt-free, but you should have your finances organized enough to handle any surprises. Step 2, set clear financial goals. You don't just want to invest for the sake of investing, you want to have a reason behind it. Ask yourself, are you investing for retirement? Do you want to buy a house in the next few years? Are you building a long-term wealth plan? Once you've identified your goal, make it specific and measurable. For example, instead of saying, I want to save for retirement, say, I want to contribute $500 to my retirement account each month. Having clear goals will help you decide the best investment strategy for your situation. Step 3, choose the right investment account. There are several types of investment accounts, and picking the right one depends on your goals. Here are a few common options. 401k or 403b. These are employer-sponsored retirement accounts that often come with tax advantages. If your employer offers a match, definitely take advantage of it. IRA, individual retirement account. A great option for retirement savings with tax benefits, and you have more control over your investment choices compared to a 401k. Brokerage account. This is a more flexible account if you want to invest for goals other than retirement. It allows you to invest in stocks, bonds, ETFs, and mutual funds, but it doesn't have the same tax benefits as a 401k or IRA. You don't need to open every account, but choose the one that aligns with your goals and make sure you understand the tax advantages or restrictions before you dive in. Step 4, understand the different types of investments. There are a lot of ways to invest your money, and you need to know what's out there before you start. Here are some common investment options. Stocks, buying shares of companies. Historically, stocks have offered the highest returns over the long run, but they come with risk. Bonds. Essentially, you're lending money to companies or governments. Bonds are generally lower risk than stocks, but they also offer lower returns. ETFs, exchange-traded funds. A collection of stocks or bonds grouped together. ETFs are a great way to get diversification without having to pick individual stocks. Real estate. If you're interested in property, real estate can be a great investment, though it requires more capital and management. The key here is diversification. Don't put all your eggs in one basket. A well-rounded portfolio often includes a mix of stocks, bonds, and other assets to balance risk. Step 5, start small and invest regularly. One of the biggest mistakes new investors make is waiting until they have a lot of money to invest. The truth is, you don't need thousands of dollars to get started. Even if you only invest $50 or $100 each month, that adds up over time, especially if you're consistent. Set up automatic monthly contributions to your investment account so you don't have to think about it. And remember, compounding is your friend. The earlier you start, the more time your investments have to grow. Step 6, be patient and avoid timing the market. I know the stock market can be exciting or stressful, but trying to time the market by buying and selling based on short-term movements is a recipe for disaster. Instead, focus on a long-term strategy. Investing is a marathon, not a sprint. Stick to your plan, keep contributing regularly, and don't panic when the market fluctuates. The key is to be consistent and let your investments grow over time. Step 7, diversify your portfolio. This is a big one. When you put all your money in one investment, you're taking on a lot of risk. But when you spread your investments across different asset classes, like stocks, bonds, and real estate, you reduce the risk. One easy way to diversify is by investing in ETFs or mutual funds that hold a mix of different assets. This way, you're not relying on the performance of just one stock or industry. Step 8. Keep learning and stay informed. The world of investing can be complex, but don't worry, there are plenty of resources to help you out. Read books, listen to podcasts, watch YouTube videos, and follow credible financial blogs. The more you learn, the more confident you'll feel about your investing decisions. And remember, you don't have to know everything at once. Start with the basics, and as you get more comfortable, you can dive deeper into advanced strategies. Step 9. Review your portfolio periodically. As life changes, so should your investments. Maybe your financial goals shift, or you want to take on more risk, or less risk, as you get older. It's a good idea to review your portfolio every year to make sure it's still aligned with your goals. If you're not sure where to start, a financial advisor can help guide you through the process. Lastly, Step 10. Stay consistent and keep your emotions in check. The market will go up and down, but it's important to stick to your plan and not let emotions drive your decisions. Investing is all about patience and consistency. Keep contributing regularly, stay calm during market dips, and remember, financial freedom takes time. So, to quickly recap, here are the 10 steps to start investing and work towards your financial freedom. 1. Assess your financial situation. 2. Set clear financial goals. 3. Choose the right investment account. 4. Understand the different types of investments. 5. Start small and invest regularly. 6. Be patient and avoid timing the market. 7. Diversify your portfolio. 8. Keep learning and stay informed. 9. Review your portfolio periodically. 10. Stay consistent and keep your emotions in check. Investing doesn't have to be scary or overwhelming. By taking these small steps, you'll be well on your way to building wealth and achieving financial freedom. If you found this video helpful, don't forget to like, subscribe, and drop a comment below if you have any questions or thoughts to share. I'd love to hear from you.